Hello and welcome to The Pitch. My name is Chris Conway. Today I am sitting down with Glenmore Asset Management Chief Investment Officer Robert Gregory. He is going to be talking to us about the exciting opportunities in the small and mid-cap space. Rob, nice to see you again.
Great to be here, Chris.
Rob, how much do you focus on macro, if at all, and how do you see things unfolding over the next, let's call it 12 to 24 months?
Yeah, look, macro is not a big part of the companies that fall into the portfolio. Most of it's just bottom up, finding great businesses that stack up from a quality point of view, earnings growth, valuation perspective. But look, I'm always very monitoring the macro situation. Obviously, we're moving to a period where inflation is a little bit high, but largely under control. Rate cuts are playing out in the US, which has obviously been very beneficial. At the moment, it appears that rate cuts in Australia keep getting pushed out, which is unfortunate for the small to mid-cap part of the market. I guess the one point I would call out for the macro piece that I do use is almost more of a contrarian point of view. So, as an example, a few years ago when bond rates were moving up quite aggressively because of inflation being too high, that resulted in a few sectors really facing some challenging near-term trading conditions. So the consumer discretionary companies were struggling with the cost of living pressures and interest rates going up. The REITs were struggling because, as we know, REITs tend to underperform when bond rates are going up. And even some of the market-linked earners like the fund managers and the platform businesses were being sold off just with falling equity markets. So where I do use the macro piece is actually, from time to time, a certain set of macro conditions which are making trading conditions quite tough for a sector in the near term, so the next 6 to 12 months, that can actually be a trigger to start doing the work on those companies in those sectors, because often you have a situation where the earnings outlook for the next 12 months is tough, but it hasn't really impacted the medium-term outlook, even though the stock prices might have been sold off quite a bit.
Rob, what are the biggest risks to the outlook and what are one or two factors that you think could change your mind?
Perhaps inflation. The central banks have done a lot of heavy lifting, getting it down from those sort of 6 to 8% levels down to sort of 2.5%, 3.5%. I think with Trump getting into power, some of his policies, potentially look like they could be inflationary. So I think that's something we've all got to monitor. So that's probably a bit of something that you've got to keep an eye on. Certainly if we saw a return to an environment where inflation started picking up, perhaps central banks had to start lifting rates again, that would be a trigger to reevaluate, certain holdings in the portfolio.
So just on that, Rob, if that case were to eventuate, inflation goes up, we don't get any rate cuts in Australia, we get rate hikes, heaven forbid, that changes the earnings outlook for some of the positions in your portfolio. And then are you just looking to exit them and maybe hold a bit more cash and keep powder dry? Like, how does it play out in terms of what it looks like in the portfolio?
It would be a trigger to probably further look at the valuations of certain stocks in the portfolio. And I think also, like at the moment, the fund's got quite a decent cash holding, as it typically just does, on the basis that invariably we have corrections along the way. But I think it would be a modest shift, but you wouldn't see a radical change in the companies in the portfolio.
Rob, enough about the negative. Let's focus on the positive now. If the stock market was to close for the next 5 years, what's one stock in your portfolio that you'd be happy to hold?
Yeah, it's a great question. The company I would nominate would be Arena REIT, which is a REIT that's basically acts as a landlord. Vast majority of the tenants are childcare centres. That does have a small number of healthcare tenants, but childcare tenants, the positive attributes of the leases in the childcare sector, and particularly for Arena in particular, are very well documented. So very long leases. So the average WALE for Arena's leases are around 18 to 19 years. Has very positive lease structure. So every year the rent will increase by the higher of CPI or a fixed set percentage. So that's very positive. The leases are typically triple net leases, which essentially means the tenant is responsible for all of the maintenance and upkeep of the property. And the last point I just say is that the occupancy is very high. So 99.7% occupancy of the portfolio. So very high quality characteristics. In terms of the valuation's probably not as cheap as some of the lower quality REITs. However, I think if we're turning off the market for 5 years, I think I'm going to put a bit more weight on the quality of company and probably a little bit less on on a cheap valuation. It's also a company, it's had a long history of producing very consistent growth in earnings per share and dividend per share. So it's a company I feel very confident in.
Rob, you've mentioned a couple of times that at the core of a great investment is a company delivering a great product or service. Oftentimes they're doing something innovative, they're disrupting their space to deliver that great product or service. What is one company that you hold that you think is doing that really well?
The company is Hub24. It's really had a long history of being very innovative. Being a platform business, it's essentially a software provider to the financial advisor and financial community. And I wouldn't say there's been any one or two big bang pieces of innovation, but rather just a long number of iterative improvements to their platform. Jason Entwistle, who's the head of product strategy at the company, he's been there for really since the start, and the company's innovation effort is very well organised. They've got a Hub Innovation Lab, and that's a group of people who are purely there to constantly look at how they can improve the product, how they can make life better for the advisor, how they can allow financial advisors to service more customers, which ultimately makes their business a lot more scalable. One thing Hub24 did was back in 2018, 6 years ago now, they identified machine learning and AI as critical features, critical things to really implement into their product. So they've done some things like using AI to scrape data off forms that previously wasn't being scraped off, and then using that data to streamline operating processes. The other thing I think I'd call out is just they're very customer obsessed. So a lot of the innovation comes about from Hub being very close to the advisors and their customer base, listening to where they think it can get better. And as Hub24 often say, sometimes you need to be innovative, you need to admit you're wrong, and you need to go back and wipe something you've done 2 years ago and improve it. It's a really high quality, innovative process that they're running.
Rob, just to follow up there, if I may, correct me if I'm wrong, one of the knocks on Netwealth and Hub at one point was there was sort of a race to the bottom in terms of margins in order to attract fund flow. Sounds like from what you're saying that they're using the innovation angle to add features, add benefits to overcome, maybe they're getting less margin, but they're attracting more clients because of the features of the product. Is that a fair assessment?
Yeah, look, I think the margin pressure was very heavily picked over by the market a few years ago for Hub and Netwealth, particularly when BT Panorama came in with some new pricing. The fee pressure will always be there to some extent, but it definitely has moderated in recent periods, just because I think the larger incumbents realise they still have to be making a profit. And look, the industry as a general comment that there is a lot of investment needs that need to be made. So I think the pricing has become more rational in recent times.
Rob, last one for today. What's one piece of advice that you think is important for investors to remember over the next couple of years?
Be really disciplined on the valuations in the stocks in your portfolio. We live in an environment where companies that perform really well, their valuations can move very quickly and to quite expensive metrics. So I'd say be really disciplined on valuation. I'd say keep a decent cash holding, because invariably we will have corrections along the way, and those corrections can be really good opportunities to buy companies that you own at attractive prices.
Yeah. Rob, thanks so much for sitting down with Lovewire. It's always a pleasure.
Thanks, Chris.
If you enjoyed that episode of The Pitch as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel, because we're adding lots of great content just like that every single week.